Morning, afternoon, or evening. Today I want to talk to you about the framework that I worked on way early this year, around January of this year. I looked for a slowing in the economy. I looked for interest rates to invert and for short-term rates to rise because the Fed's going to keep raising rates aggressively. And I looked for gold prices and any long-term assets, including cryptocurrencies, to remain depressed. And everything's going as planned. Only thing I'm tweaking a little is that I think the economy is slowing down at a slower rate than I thought it would. We're at September 1st. This is the labor report preview, and the labor report comes out tomorrow, September 2nd. And the economic statistics have been much better than I expected, and it's taken us longer time for it to slow. However, nevertheless, I still expect the economy to start slowing very soon, within a few weeks, because I do see some weakening of that growth. And since the labor report's coming out, I'm going to talk to you about that. ADP reported their numbers, and they had reported 268,000 new jobs for July. And a few days ago, they reported a decrease of that growth from 268,000 to 132,000. So that's a slowing in the payroll growth. Now, the ADP numbers have been terrible and wrong, and so they revised their methodology, so hopefully it's better now. Now, speaking of labor growth, the labor report, as I said, comes out tomorrow. It's going to be for July and for August. And for July, we had a huge increase in labor growth. We had 520,000 jobs created. I expect that to slow down. Economists expect around 318,000 jobs will be created in August. I think that's going to slow down to maybe even lower, maybe 315 or 300,000 jobs being created. And that should keep a lid on interest rates, because over the last 2 weeks, we've seen interest rates, especially long-term, no, even short-term rates, rising. And the 210 spread has actually decreased by 40% over the last month. It was over 40 basis points. Now, as of today, September 1st, we're about 25 basis point spread between the 2-year note and a 10-year bond. So that spread is declining. But here's the deal. If the labor report is even okay, I'm still expecting the Federal Reserve to keep raising rates. And they're probably going to raise rates 75 basis points at the next FOMC meeting this month. Let me see if I covered everything. Yeah. Oh, one more point is the ISM report. ISM, remember I talked to you about economic data points have been stronger than expected. That's hard data points and soft data points. When I say hard data points, I mean like the labor report, durable goods, industrial production. Soft labor points, soft economic data, I should say, is like the survey data, like consumer confidence. And as of today, we received the ISM data. I've been expecting the ISM PMI data to fall off a cliff, and hasn't yet. Today's ISM data was better than expected, and it was flat month to month. And for August, it was 52.8, so that's flat with last month. And I expected it to be below 50 by now. So one error that I've made is that I expected a more rapid decline in economic indicators. That has not happened yet. So what I did is I did a drill down into the ISM report to see what the respondents and survey questionnaires were saying. And they did say that production's high, and prices are starting to decline, and exports are starting to decline. So that's saying that there is some slowdown. But one really important thing is I meant to say that while they're saying that production is still strong and everything's looking fine and dandy, what they're saying in their words is that they're fearful that they're producing and producing and selling, but they're worried about bloating inventories. So I feel like we're on top of a cliff, and manufacturers know that. They know that we're on top, and there may not be anything below us. And so they're producing because they're getting orders. Like they have to produce because they're getting new orders. But at the same time, they're worried about bloated inventories. And we're seeing that in other places. I mentioned this before in my previous videos, that even though there's a shortage of chips, we're seeing the opposite in some areas. We're seeing chip companies like Micron and NVIDIA, AMD, Intel, and then disk drive companies like Seagate, Western Digital, and hardware companies like I think it was Cisco, but there was another one, Dell Computer, and HP. They're all reporting slowdown in inventories. That the inventories were too high, and also if you look at the cloud companies, this is an industry I've been following closely for many years since it got started. I've been following technology, I think, for 30 years now, but I've been following cloud companies since Salesforce went public. And what I'm noticing now with cloud companies, also called SaaS, software as a service, is that they're seeing a slowdown in orders, but they're not seeing the brakes being put on. They're having a hard time having their sales close for business, meaning that they can't get their contracts executed. And so there's some kind of sales slowdown, but it's not because the economy's slowing down, it's because the customers are fearful about what I said earlier, that the economy's slowing down, that inventories are growing. So they are reporting some sales slowdown. So I think we've got a mixed bag here. So as a conclusion and key takeaway, my framework was that economy would slow down quickly and long-term rates would decline, and we're not seeing that yet. We're still seeing a strong economy, but at the same time, we're seeing a decline in export orders, as reported by the ISM, a declining pricing, perhaps because there's less demand, and we're still seeing bloated inventories. And we're also seeing a slowing in ADP jobs growth. So I think we're at the precipice of sharp decline in economic data. So you just have to be patient. And what does this mean for the stock market? I think stocks will continue declining. They're probably going to go up Friday when the labor report goes out, because I think the labor report may be weaker than expected, so interest rates will decline. But the problem is that investors are going to start worrying about earnings rather than interest rates as we go forward. And that's going to compress and lower the stock market. And at the same time, that's going to lower interest rates, long-term interest rates. So as the Fed keeps raising rates, you're going to see long-term rates like the 10-year rate and the 30-year rate, they're going to flatten and maybe even decline. So you're going to get that inversion in the yield curve. And again, once again, the 10-2 spread is about 25 basis points, and I think that's going to rise to at least 40, 50 basis points in the coming week. So good luck and be safe out there. Thank you.